This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcast, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, we've got a great show for you today. This is a very interesting man and company that is just really going crazy right now in the real estate investing market. And I'm talking about Gary Beasley. Gary Beasley is co-founder and CEO of Roofstock, a leading technology-enabled marketplace and investment platform for the $3 trillion single-family rental sector. Previously, he was co-CEO of a publicly traded company, Starwood Waypoint Residential Trust, now part of Invitation Homes, and is known as a pioneer in the development of the single-family rental sector as an institutional asset class. Gary also served as CEO of boutique hotel company Joie de Vivre Hospitality and award-winning solar technology startup Greenvolts. Between 2001 and 2007, Gary was CFO of Zip Realty, where he led the innovative internet-based residential brokerage through its IPO before eventually being named its president. Gary also spent 6 years with KSL Resorts, working for leading real estate industry firms, LaSalle Partners, now part of Jones Lang LaSalle, and Security Capital Group. Gary earned a BA in economics from Northwestern University and an MBA from Stanford University Graduate School of Business, where he serves as a regular guest lecturer. Well, Gary, wow, that's a mouthful here. Welcome to the Old Dogs REI Network.
Hey, Bill. Great to be on with you.
Wow, well, you've got a great background there, and you've got a very interesting story to tell. But usually before we start off, our audience really likes to know the sort of the person behind the mic there on your end. If you wouldn't mind, just kind of, just give us your background and, where you came from and how you kind of moved into the space that you're in.
Sure. So I grew up in a small town in Northwest Indiana. It was kind of a mix of steel country and agriculture. Town of about 25,000 people, and really spent the formative years there, and then went off to college, as you noted earlier, at Northwestern, where it kind of opened my eyes to a number of new things and got me very interested in economics, which is what I ended up majoring in. Sort of set me on a path that took me out of the Midwest and brought me more to the West Coast, where I went to graduate school and have ended up making a life here in the Bay Area. But I would say I've got a passion for real estate and innovation, and have tried to make my career at that intersection. And have done, as you noted, a few different things. What I've found with myself personally is I like building things as opposed to maintaining things that are already stabilized. And so I've tended to gravitate towards some earlier stage opportunities, trying to look around the corners a little bit at what trends are developing in real estate in particular, and try to either build or join models that I think could be transformative. And I've always found if you can do something where you've got a bit of a macro tailwind, it greatly enhances your ability to be successful. And so I've done that with a number of different sectors, including, as you mentioned, hospitality, spent some time in the solar industry, and some real estate technology with Zip Realty as the first online brokerage. And then most recently in the single family rental space, which I've been involved with now for about a decade, I guess, in various capacities as an investor and business builder. So, happy to talk about a number of those things as we get into the conversation about investing, because there are some commonalities across the real estate asset classes. There are also some differences, which I'd be happy to chat about.
Well, it's just a really interesting sector that you've kind of ended up in, and which I think is very innovative. I think it's you found a niche that definitely is an area that it seems like was overlooked, if you ask me. Can you kind of describe, specifically how you discovered that area and where you how did you know that there was a need in that, and especially in that SFR market?
Yeah. So I originally got involved, a couple of friends of mine, in particular Doug Bryan, who is the co-founder of Waypoint Homes, is a friend of mine. We live in the same town. Our kids played soccer together. Doug's a former NFL kicker, really good guy. So we were just chatting at soccer tryouts for our girls, and he mentioned he was starting to buy some homes in the far East Bay here, or the Bay Area, it's really significant discounts. And this was about 2009. And he was describing to me what he thought was the opportunity where you could buy homes that were $400,000 at the peak for about $120,000, put $20,000 or $25,000 in them, and then rent them out at a nice yield. And the idea was you could either, just buy a bunch of cheap houses and sell them in the future, or maybe even build a platform and create effectively like a horizontal apartment building by buying a lot of homes and trying to manage them efficiently using technology. And so I thought the vision was really interesting. And so I ended up investing some money with Doug and Colin in a couple of their early friends and family funds, and spent some time as an advisor with those guys. And then in 2011, ended up leaving my private equity job to dive in and build Waypoint Homes with them to raise institutional capital. And what was apparent to me back then was U.S. housing was at the time, and still is, the largest asset class in the United States. It's about $25 trillion in the housing sector. And what we realized was there was $2 or $3 trillion that was rented out long term, and there was no efficient way to invest in that asset class. It was very mom and pop controlled, no institutional capital, no tools. The financing market was poorly developed. So we thought, geez, this could be and should be an institutional asset class where if we could figure out how to aggregate enough assets and manage them efficiently, I bet we could attract a lot of capital and build a real company around it. And so that's what we embarked to do in 2011. And back then it was basically went from zero institutional investment in 2009 to fast forward a decade later. Today there's probably 40 or 50 billion of institutional ownership in single family houses. And so we were at the forefront of opening this asset class up to institutions who really kind of brought capital to bear during the housing crisis. If you recall, no one was buying homes back then, 2009, 2010, 2011, and a lot of the homes needed a lot of work. And so in early 2012 is when housing started to appreciate again after 5 years of decline. And once that institutional money came in, it formed a bottom. And then since then, housing has been up and to the right, and it's supported in part by this institutional investing, but it restored confidence to the market.
Yeah, you came in definitely at the right time, both as an investor and in the formation of your company. And that is an area that I think a lot of people don't even realize. For the most part, I would say that investors have had to do pretty much everything themselves. They had to just go out into the marketplace and try to find a good rental property and do whatever had to be done to get it ready for sale or rental. And, that's just kind of been the standard for so long. And then there's also the sort of turnkey market, which sort of does that for you. But to be able to see these properties available, just like you'd go into, realtor.com or Truly or whatever, where you have a home, but the home, the difference is the home has a rental history that you can check up on. You can get the numbers on it, and there's tenants already in it. And for the most part, that's just a whole different ballpark. And it opens up a lot of opportunity, I think, for investors, especially in that SFR market.
Yeah, that's exactly right. I think what I like to describe, the initial wave of real estate technology, you mentioned Trulia, got Trulia, Zillow, Realtor.com, et cetera, LoopNet. These were about content, and Real Estate 2.0 is more about commerce. So being able to actually transact through platforms like Roofstock that just make it that much more efficient and use technology and data software to make it more accessible. And really what we've tried to do is break down the geographic barriers to real estate investing. So you could be sitting in Haiti where you used to live, or here in the Bay Area where I live, or New York City or Cleveland or wherever, buying homes in Atlanta or Birmingham or Phoenix, any of these places, sight unseen. So really breaking down the geographic barriers to investing, which really opens up the whole country then as your oyster, rather than 70 or 80% of investment homes are owned within an hour's drive of where the owner lives, which is kind of the old school way to do it because it's convenient and you know the market, and you wouldn't really know how to go about it outside of your own market. And so what we've tried to do is turn that on its head and say, well, if you want to have a diversified investment portfolio, you wouldn't say own all of your stocks in just one sector, or you wouldn't just buy companies that are headquartered in Atlanta, right? You buy a diversified portfolio. I think it's the same with houses. If you can use a platform that will give you that exposure and an ability to manage them efficiently across different geographies, then you're not totally correlated to where you happen to live and own rental properties.
Yeah. Now, do you have a lot of sort of out-of-country investors? And is there, I would imagine there'd be a fair amount of sort of out-of-state investors, people that are investing all around the country. Is that pretty common with?
Yeah. So 93% of our investors live at least, I think the stat is 93% live at least 250 miles away from the homes they're buying. And we have about 20% of our website traffic now is global. So we do have a fair number of international investors, although we're certainly not selling 20% of our homes to international investors, but increasingly in the post-COVID world, our international traffic has really spiked. It's gone up by, call it 400 to 500% since pre-COVID. So there's a lot of interest from different parts of the world to figure out how to get exposure to U.S. housing, which is interesting. And I mean, that's one of the things that I like to cite as you think about assets where you would like to have exposure. U.S. housing, I think, is very interesting and increasingly becoming interesting to global investors. And it's not just the luxury condos in Manhattan where it used to be, or Miami condos. You're seeing people from all over the world buying $150,000 rental homes in a market like Atlanta or Phoenix. So I think when you think about the supply-demand characteristics of single-family rental housing, it's very interesting. There's going to be a lot of renters in the upcoming years, I would posit, for lots of reasons. And so the fundamental demand for the product is strong. The debt markets are readily available. Interest rates are low. And so when you look at that, supply-demand dynamic. I think it creates a pretty attractive place to invest some capital over the kind of medium to long term.
Yeah, well, some of the recent stats, even some things that came out today, I think it's just showing how robust the market still is, despite the COVID, despite the economic challenges. I mean, I'm going, wow. I mean, this is still strong. Yeah, I was expecting to see a dip here. In fact, investors were all kind of looking forward to a dip. It sounds kind of morbid there, but so that's when you pick up the good deals, right? And but.
Yeah.
There really wasn't much of a dip here. So
no, I was looking at some of the stats this morning, and normally on our website, properties tend to trade about 97% of their asking price generally, and that's been historically pretty consistent. During the depths of COVID in kind of April, we saw that drop to maybe 95%. Now it's back up to kind of 96, 97% of list price. So. And we're approaching record levels now again of activity. So and I think what's giving people the confidence is one, price. There's just so little supply out there, so that's helping prop up prices. But people have been paying their rent, and the primary question people had was, in this environment, would there be massive delinquencies and bad debt? And I can't say that this will always be the case because you can't predict the future. But to date, through this time, through the month of June, the collections have been essentially in line with pre-COVID levels, as people value their living situation maybe more dearly than ever. They don't want to have to find another place to live. They don't want to move. They're hunkering down, and so we have found housing being almost viewed like a utility. It's a necessary thing. And so it's been very stable. And that's given people a lot of comfort relative to some other real estate assets and asset classes that have been really impacted, like hotels, restaurants, office buildings. You look at a lot of those businesses that could have significant structural impairment in their demand for some time. One could argue maybe office demand, may never get, or in any reasonable time, get back to where it was if half the people decide they can work from home. I think travel is going to be impaired for a while. So housing has been a beacon for a lot of investors.
Yeah, it's really great, and I think it's you're also in a great space in terms of being totally online, that people can shop without having to drive around necessarily. They've got a lot of information online. I mean, you have market information, you have data about the property itself and its history. But as an out-of-state investor, for example, do you help them in terms of finding property management for these properties?
Yeah, that's key. So when we first came up with the idea, my co-founder, there were two co-founders, Gregor Watson, Rich Ford. My co-founders and I put our heads together and we said, okay, what do we need to solve for to get people to buy homes sight unseen? And what we realized was people really just needed to understand the condition of the home and whether it's got a rentable floor plan. The other things could be done remotely, whether it's showing the tenant payment history, running title, all these kind of Google Street Views, school scores, neighborhood scores. So we were able to basically solve that last mile of information. So you could be sitting at your computer looking at pictures or floor plans of homes that have been inspected, and you can buy with confidence. And then what we did was we said, okay, for people to use us, we need to stand behind it. So we came up with a 30-day money-back guarantee concept. So if you buy a home through Roofstock and you're not happy, we'll resell it for free. And if we have to sell it for less, we'll cover the difference. Very rarely do people invoke that, but it's nice to know it's there. It's kind of like booking that airplane ticket that's cancelable for 24 hours. So building confidence and credibility was really paramount in the early days, and so that's what we've done. And at the end of the day, what we've created is an experience where we effectively have touchless delivery of houses, right? Which is perfect for today's environment. You can shop and buy without ever seeing these homes. I bought a home 3.5 years ago on our site in Cape Coral, Florida. I've never seen it. The rents just keep coming in. And someday I do hope to see it if I'm ever down in that area, but I never have. And it's a pretty typical story of a lot of our investors.
Now, did you have to find your own property management for that home?
Yes. Oh, sorry. I neglected to answer that part. Yeah, no, we pair people up with property managers. So when you go through and look at a property, we'll recommend certified property managers in that area, and you could select whoever you would like at checkout. So it's typically 2 or 3 firms we've negotiated service level agreements with, favorable pricing, et cetera, who we vetted as being good. And then you select them, and then during the closing process, they take over, the lease gets transferred over, they take over the property management, and it's seamless. So you don't have to ever go there and find a property manager. You can pick one that we've done the work vetting them.
That's great. That's great. What about market information? I mean, that's sometimes as an investor, you can buy on one block and then move over a block, and you get a totally different response in terms of renters and so forth. Do you provide any kind of market information for people shopping?
We do. We provide quite a bit of information. We have a decent sized data science team, and we crunch a lot of numbers. And I think in particular, there's a couple things I would point to. Is one, we have neighborhood scores that are from 1 to 5 stars, and that's a proxy for risk. The 5-star neighborhoods they tend to be higher end, better schools, perhaps lower volatility, but also perhaps lower yield generally than some less expensive homes where the rent is a bigger percentage relative, or is bigger relative to the purchase price, so you could get higher yields typically, but you might have a little bit more volatility, variability of return, just like a stock that might be a little bit riskier versus a bond that might be more safe, and everything in between. So we rate the neighborhoods down to the census tract level. So these are typically 200 homes or so in each census tract. So you can look at your neighborhood score. That really helps gauge what kind of neighborhood you're in. And then also remember, these homes for the most part are already leased, so you could see the market rent of that home and what the yield is going in. And so to a degree, the market is telling you what the market rent is. And we also, which is a good proxy, because it could be that the rent is $1,200 on one block and it's $900 on the next one, and you could see that on our site, and that's already priced in. So you would be able to buy that at an appropriately lower price. So it's all about making that information available. We're also working on some pretty cool technology that takes into account the very specific location of homes based on a number of factors that are either additive or could detract from the value of a property in doing some automated valuations. So, for example, if you're across from a park, it's better than, say, being directly across the street from a school that might be noisy. You might want to be a block away from the school. That's great, but right across from the drop-off, maybe that's a little bit of a negative. Do you have street noise? Yes or no? Do you have power lines? Yes or no? Those types of things get factored in. And it just helps you make those decisions. And it's not to say that those properties with some of those, I don't want to call them impairments, but characteristics, each just gets factored into the value. And the idea is, with any investment, making an appropriate return for the asset that you're buying. And the beauty of a marketplace is we're not necessarily recommending or not recommending homes or neighborhoods, because buyers and sellers, obviously, they need to come to terms on what price makes sense for that asset. So as a marketplace, we're just there to create transparency and a better way to transact and allow buyers and sellers to come to those conclusions themselves, because obviously they both feel that at that price, the transaction makes sense. One of them is not necessarily right or wrong. It's just that's the price. And I think that's the beauty of a marketplace.
That's great. What about search parameters? That seems like it'd be a key element. As an investor, I could imagine going in there and saying, "Well, yeah, I want to see what markets meet my criteria in terms of ROI or price point." I don't know how many different factors you might be able to put into a search, but is it possible for somebody to do that sort of on a national basis, where they'd be able to put in what they're looking for in terms of their criteria, and come up with viable homes to purchase that?
Absolutely. So, in fact, many people do their search based on parameters that aren't necessarily by geography. They're looking for maybe certain characteristics of the home, maybe homes that are 1990 and newer, that have at least a 3 neighborhood score, that have at least a net yield of 5%, that have at least 6 months left on their lease with a tenant. And the tenant's current. You could search by those types of parameters. You can search by expected return, neighborhood, age, all those kinds of things. And so what we find is people may come to us with an expectation that they want to buy a home in a certain area, and they put in search parameters. And I know sometimes we'll launch a new market, and all of a sudden people who'd been looking in other areas will start making offers in a market that we've just launched because it has the characteristics they're looking for, but they say have never thought about buying a home in St. Louis or Kansas City or Birmingham or Charlotte, but all of a sudden now they're seeing these homes. We've started to sell some homes through in Augusta, Georgia, for example, which we were able to buy last year from one of the institutional players. And we're reselling them now through our marketplace with tenants in place, and they've been very popular. And no one had really thought about buying a home in Augusta, Georgia, but it's the second largest city in Georgia. It's got nice growth characteristics, great quality homes, and the homes show pretty well, and so very well. And so if you're sitting here in the Bay Area, you wouldn't go to the Georgia MLS and start looking at homes in Augusta. Unless you're a big fan of the Masters, maybe you would. But you see these homes and you say, "Gosh, these are really nice assets. I'm going to add it to my portfolio."
Okay, that's great. I mean, do you have, for example, and again, I'm just kind of off the top of my head again as an investor, do you have sellers that are willing to do, let's say, seller financing, and would that be something you'd list as an option? I mean,
yeah. Sometimes that is the case. Sellers will offer seller financing. It's pretty rare. It's not something that's common on our site, although it does happen. We do work with buyers and help connect them with lenders who are active in the space and can help them get their loans. There's pretty attractive financing available, even if you can't get the seller financing. From Fannie and Freddie, where you can borrow, say, up to 80% of the value of the home on attractive terms. So that's what a lot of our buyers end up doing. We certainly have some cash buyers, but the majority of our clients want to diversify. And so let's say they have $100,000 or $150,000 they'd like to invest in the sector. Oftentimes, rather than buying a single property, what they'll do is they'll buy 4 or 5 with this financing and get a diversified portfolio. And generally the cost of the financing is less than the unlevered yield on the property, so it's accretive, and so you're generating cash flow over and above what you're paying for your expenses, and so you're putting a little bit of money in your pocket as well as building equity value over time. One of the nice things about real estate is financing is readily available. And I think interest rates are going to be low for a long time. That being said, I'm not suggesting you shouldn't lock in fixed rate financing over the long term, because I think because rates are so low, you might as well. But I don't think you're going to miss out over the next year or two. I think rates, for lots of reasons, given the global economy, will stay very low for the foreseeable future.
Yeah, I agree with you. You entered into sort of a new space here in the formation of Roofstock, and I would imagine there's a lot of things encounter, even though you've got, it sounds like just a top-notch crew that put things together, there are those mistakes that happen early on that you learn from. Is there something you could bring out that was maybe something you didn't anticipate, or something that you did anticipate that didn't end up being as important as you thought it would be, or whatever, that helped shape the direction of your company?
Yeah, absolutely. Gosh, where do I even start? We've made a lot of mistakes. But that's the beauty of these startups. You can make a lot of little mistakes and test things. And then when you find something that really works, you fan those flames and you go. So early on, I would say one of the mistakes was we were overthinking it. Our approach was too complicated, and we were offering too much choice, and it was overwhelming to people. So what we've decided, or what we've learned over time, is people really want much more simplicity and much more curation than having tons of choice. The feedback was, guys, gosh, I have so many homes to choose from. I don't need to look at 9 different insurance providers and 6 different mortgage providers and 8 property managers. Tell me the best kind of 1 or 2 that I can choose from, and make it easy. You guys do the work and do the vetting. And so that was something I think I thought people would value choice over simplicity. And it's turned out to be the opposite. And so we've kind of looked through that lens now. And I would say the other thing is we didn't invest as much in the early days in data science as we have over the last couple of years. And I wish we'd gotten started earlier in as intensively as we have in the last 2 or 3 years, because I think that's turned out to be an asset that's super helpful across the business for customers and for us. And so I would say I would have hit the accelerator a little bit more with our data science investment early.
That's a good point. What would you say sort of is one of your biggest successes, something that you did that just turned out to be just home run out of the park, where you might have thought maybe it just would be just a normal factor of operations?
With Roofstock specifically?
Yes.
Yeah, I would say one thing that we launched last year, and we weren't really sure how people would react to it, was we launched a fractional ownership program called Roofstock One. And this is only for accredited investors. But if you were an accredited investor, what you could do is you could buy a share of a home that we owned and dropped into a trust. And you could buy as small as a 10th share. And that home is already financed, insured, there's a tenant in it. We do the property and asset management. And it totally hands off. And then in the future, instead of selling the home, you just sell the shares, and like a share of stock. And it's actually a security. And so the idea was, it's almost like if everyone who's listening is familiar with a REIT, a real estate investment trust, it's almost like a REIT of one house, right? You're buying a share of a home. And what it allows you to do is take, if you have $30,000, instead of using that as the down payment on a single home, you could take and buy $5,000 or $10,000 slivers of multiple homes, say across markets, and get diversification. And we weren't sure how the market would react to that because you're not buying title to the home. You're buying an interest in the profits and future appreciation of that share. There's no established secondary market yet, although you can sell that share to another accredited investor. So it just wasn't clear whether we'd found product market fit with that. And as it turns out, it was extraordinary. There was a ton of demand for it. We sold out of the shares, and we're in the process of hopefully relaunching with a new cohort of homes and shares later this year. But that was one where until we turned it on, we didn't know if we were going to throw a party and no one would show up, or whether there'd be a line out the door. And it turned out there's a line out the door. So we've got to figure out how to scale that program. It's really for investors who want to be totally passive. We have certainly some people who want to pick their own homes, own 100% of them, pick the financing level, pick the property manager, pick the insurance. We have others who say, you guys do the curation, you buy homes that you really like and manage them. I just want to kind of buy a piece of that. And so that's the continuum.
Interesting. I didn't know you guys did that. That's fascinating. Wow. You're also an investor as well as the CEO of the company. What has your investment experience helped you to, just in terms of your insight in putting this company together, helped you to really make it more effective?
Well, I think that at a very fundamental level, I guess what I've realized over the years is, I mentioned there's some commonalities and some differences across asset classes. Generally, risk and return tend to be pretty correlated, right? You need to take more risk to get the higher return. So how can you really help assess the right risk-adjusted return for each asset? And that's something that we're trying to help with. And since I've done investing across hotels and all sorts of multifamily, single family, I think having an appreciation for those trade-offs and trying to make them transparent has been helpful to me. I also, having been in operationally intensive real estate like hospitality and rental homes, you realize the importance of operations and those operating variables, and how much managing both your capital spending, your operating expenses, and growing your top line can really improve your returns. And so, one of the things I learned in the hotel business, so we were doing these complex resorts. If you could buy something on its existing cash flows, but you have a thesis for how you can improve it, typically through some additional capital investment or a repositioning of the asset, you could actually end up paying what appears to be a very fair price to the seller in the condition that it's in. But whether it's a resort, where I know the first resort that I led the purchase on back when I was with KSL Resorts was in northern Michigan. We bought it at a very fair price, about a 10 cap. So it was pretty. It was a good. We still thought it was a good value, but we were able to put some money in, build a new golf course, upgrade it, and I would say we tripled the net operating income, tripled the EBITDA, and created a ton of value by investing high return capital dollars. And I think you could do the same thing with single family homes. If you find some homes that could be repositioned, whether it's upgrading the kitchen or adding an accessible dwelling unit, some things like that. So we definitely have investors who are looking to do those types of things. So there's different approaches. If you want to be creative, you can look for characteristics that might allow you to do a little value add and create even more incremental return, or you just buy stabilized homes that are more akin to bonds. So I think of single family rental homes as sort of an inflation index bond with an equity kicker. So, but what I mean is you've got an income component, a yield component that generates cash flow. Each year you can reset your rents to keep up at least with inflation, ideally. And then and that's your bond element. And then the equity kicker is, over time, hopefully prices go up and to the right, and you can sell the property for more than you paid. And if you have an amortizing mortgage, you're building equity value by paying down the debt. And so that gives you that equity kicker. And what we have found through our research is single family rental homes have tended to generate returns pretty similar to the stock market, call it 10 or 11% over the long term, and but with a lot less volatility and with almost zero correlation to equities. Today, I'm worried about the stock market levels and volatility. So I don't have a ton of exposure to public equities because I feel like the public markets are pretty disconnected with the economic realities. And so I want to be cautious about that exposure. And so when I think about alternatively real property that isn't marked to market, every minute in the public markets, I like personally in a market where there's that volatility, having some decent exposure to something a little bit more tangible, like housing.
Sure. Well, our audience are folks that are 50 years of age and older that are looking at real estate investing as a means to help them in their retirement years, whether it's to take their existing nest egg and get a higher return, or whether it is buying rental properties and maybe growing a portfolio. What would you say to that group right now that how could your platform help these folks, especially looking at doing this maybe for the first time?
Yeah. So I guess I would start with just a few basic questions to think about. How much would you like to invest? What's your appetite for risk? What's your desire for generating current yield versus total return? Do you have any geographic preferences? And then just go onto our site and sort of poke around a little bit and use some of the tools that we've built. We've built it with the investor in mind. We've tried to be as intuitive as possible and make things understandable but powerful. And by the way, we're always looking for recommendations too. If people find things confusing or looking for other tools, we build them all the time based on customer feedback. But I would say go through and look at some homes, maybe come up with a sample portfolio and see what that looks like. Maybe talk to one of our advisors. Maybe we've got some education on our site. You could listen to some podcasts. We have a lot of webinars and educational content, and really think about whether having a piece of your retirement tied up in or invested in property like this makes sense. I think for a lot of people it does, especially as you get later on in life and you don't necessarily want to have the volatility of the stock market, but you don't want to necessarily buy fixed income, which doesn't have the upside that you can get in real estate. You can have a fixed income exposure in some of these homes if you buy the yieldier ones, or you could just build wealth. So that's what I would. And if you've got a financial advisor, I think it's always good to talk to them about your own particular situation. Oftentimes financial advisors aren't wild about you taking money out of the market and buying real estate outside their account. But
yeah, that's true.
but if you have a good one, when hopefully a lot of you do, if you use outside people, hopefully they realize that some percentage of your net worth, it probably makes sense to do something like that. And we're talking to a number of wealth advisory firms and platforms about getting us on their platform, because I think the idea of being able to easily invest through your wealth manager into either directly into homes or Roofstock One shares makes a ton of sense from a financial planning standpoint. We're not integrated with anyone yet, but so for now you kind of have to go to us directly. But listen, we're here for a long time. I mean, there are people who are just starting to make offers now, have been on our site for a couple of years. And so sometimes it takes a while to get comfortable with the asset class. Sometimes people come on and within a few days they're making offers, but it's everything in between. We're here even if people just want to use us for a resource, use us for research, use our tools. It's all about, for us promoting responsible investing, helping people get educated. And to the extent our platform's a good fit, that's terrific. If not, I think it's a good place to learn and get exposure to real estate investing.
Great advice. Are you guys only single family, or do you have like small multis, like duplexes?
We have duplexes, triplexes. So really kind of 1 to 4 units is what we specialize in, which is you can still get the residential financing. Above that, you start to get into more multifamily.
Yeah, and commercial, yeah.
Financing. The majority of our homes are single family detached, but we do have plenty of attached, and we're starting to see more and more of those actually as we broaden our supply base. And a lot of investors really do like them, and the returns can be quite good oftentimes. Yeah,
that's true. Looking ahead, you said you're going to be around for a while. What's the thing that really excites you about Roofstock and, your vision for the future?
Well, I think that what's super exciting to me is real estate generally has been very slow to adopt technology. It's the largest asset class in the world probably to have kind of, I don't want to say ignored technology, but not fully embraced it. And so what you've seen over the last few years is an enormous amount, billions and billions of dollars of venture capital flowing into what's now being called prop tech, property technology. Companies like Roofstock are attracting lots of interest because it can really transform the biggest industry on the planet, and the fees in real estate have tended to be high. Satisfaction with transactions tended to be low, and it takes a long time, and there's been a lack of transparency. So when you could look at an asset class and say, by transforming the way properties trade, you can make it a lot more efficient. You could actually then put more money in both the buyer's and the seller's pocket, because you're eliminating a lot of costs, and by creating more transparency, you get better execution, better liquidity. So I see us really creating a marketplace for trading investment properties that ultimately has a global inventory of properties with global investors. So you could come to Roofstock and trade homes or shares of homes, or ultimately could be small multifamily, could be short-term rentals. Think about residential properties that have a residential component to them that could be traded really efficiently and increasingly with a global footprint. And so if we can do that, then we've definitely got 20 years of ideas, maybe more, that we're just continuing to chip away at. But there's no shortage of opportunities to continue to, service our customers. A lot of times we're adding markets that people want to see. Roofstock One, our fractional product, came out of feedback from customers who wanted that type of thing. We do have a number of customers who want to be able to buy short-term rentals, for example, Airbnb type properties, and understand the income and expense component of them, so because they want a utilization component. So that's something we've been doing some research on, and over time are likely to add. So it's really just kind of listening to the customers and continuing to hopefully build a company that people are excited to use and are hopefully will support. And we like to help people in their investment journeys.
That's awesome. Well, our time has just gone really fast here. I apologize for that. I just, it just kind of zipped by, but there's a lot of great information there, and I think our listeners are going to really appreciate it. We're at our point, though. We have what we call our wrap it up session, where I ask you a series of sort of quick questions, and you give me sort of a quick reply as sharing resources that have been of value to you. So our listeners may benefit as well. So if you're ready, we can go ahead and wrap it up.
Sure.
All right. Favorite real estate book?
Favorite real estate book? I would have to say it's actually not what you're expecting here. It's a novel. One of my favorite books I read many years ago about real estate was A Man in Full by Tom Wolfe. So it's a good read. Remember Tom Wolfe wrote A Bonfire of the Vanities?
Yeah.
But I think it's a great real estate book.
Yeah, awesome. Great. How about favorite just general business book?
I would say I just finished it, actually. I love it. It's called Entrepreneurial Leadership. It just came out. It's by Joel Peterson. Joel is one of my old business school professors from Stanford, and terrific guy, brilliant, used to run Trammell Crow Company, one of the largest development companies. Joel is an inspiring leader, chairman of JetBlue Airlines for probably a decade. Great guy. And I found this really insightful because it talks about how an entrepreneurial leader needs to be a different type of leader, a different kind of leader at different times in the company's evolution. And I just thought it was a great read and a very personal story. So I would recommend it highly.
Excellent. How about most valuable website for success from your standpoint that you access on a regular basis?
Yeah, I would have to say LinkedIn, because it is such an interesting way to connect with people and for people to find you. And so I end up connecting with many, many people through LinkedIn. I think it's fascinating that you could basically connect with anyone through 1 or 2 degrees of separation very quickly. So I have to say LinkedIn.
That's great. How about a favorite app, something on your phone that you use on a pretty regular basis?
I'd have to say Spotify.
All right.
I think it's brilliant. Yeah, I'm addicted. I think it's amazing. You could pretty much listen to any song anytime for a small subscription fee, and the idea of not having to buy individual songs or albums is, I think it's revolutionary. I'm addicted to it. Yeah,
It's a real successful app, that's for sure. How about a favorite quote?
Favorite quote? Gosh, I've been known to use a number of quotes over there. I would say, as an entrepreneur, I like a couple of Wayne Gretzky quotes. One of them is, "You miss 100% of the shots you never take," which I think about all the time when we're not sure if stuff's going to work. You got to take the shot, and if it doesn't go in, it's okay. You take another one. And then another one that I love from him is, he goes, "I skate where the puck's going to be, not where it's been." And so I
like that one.
I've really thought about that with my career, like with the whole single family rental industry. I really felt like, a decade out, this would be an institutional asset class. It actually happened a lot faster than I thought. But when you see those things, I think it's great to try to act with conviction around it. And if you're right, you end up putting yourself in a pretty interesting spot.
That's great. And you have had a lot of entrepreneurial experience, so hopefully you'll be able to answer this one real easily. Yeah, but if you, let's say, lost absolutely everything and you had to start over, and knowing what you know now, and all you have is $1,000 in cash in your hand, that's it, what would you do to relaunch your business?
So does this include going to Vegas and putting it on?
Whatever you want to do.
I probably would not do that. I think what I would do is, I think oftentimes the public markets overreact to situations. And so what I would probably do is do research I would look at REITs, real estate investment trusts, and I would look at the ones that are trading at the biggest discount to net asset value. And that's something that's readily calculable. So let's say it's a company and the net assets are worth $100 million and the company is trading at $70 million market cap. So you've got a fair degree of cushion, and find the ones that have dropped the most but are now at the biggest discount to the underlying value of the assets, because eventually over time they tend to migrate back towards that net asset value. And I've tried that over time a few times in the past, and it's always worked, because if you're patient enough, you can make some money relatively quickly. And then when things get back to that level where they should be, you could sell it and buy something else that you think is mispriced. And that's a very simple metric to look at, but you're unlikely, if something's corrected meaningfully and it's stabilized at a level that's a meaningful discount to the underlying real estate value, eventually there's going to be pressure to sell the assets by the shareholders of the board to get the value back up there. So that would be my simple tip.
Received that one. That's great. That's great. I'm sure there's a lot of folks listening that want to find out more about you, about your company. What's the best way that people can either contact you or find out about Roofstock?
Sure. Well, the best way would just be to go to our website, which is just roofstock.com, and it's pretty easy to navigate. If anyone wants to reach out to me directly, it's very simple. My email is just Gary@roofstock.com, Gary@roofstock.com. You could also reach out to me on LinkedIn if you'd like to connect that way. But that's probably the easiest ways. Always happy to connect with people who are active and interested investors, and happy to be helpful any way I can.
Very cool. Well, thank you. Wow. And the site, people can go on there. There's no charge for it. They can search around, and
it's totally free. You don't even have to register to poke around, but once you start wanting to look at diligence information and things like that, we do require an email address, et cetera, but just to register to get into some of the more proprietary information. But there's never any charge to use the website.
Well, that's great. That's great. Well, I'm sure there'll be plenty of people checking it out for the first time if they haven't already been there. But wow, this has been great, Gary. I can't thank you enough. We do have a tradition, though, on the show. We always have our guests close us out with their best old hound dog howl. So are you up for that?
Absolutely. Are we ready?
All right.
I've got my little King Charles Spaniel here next to me. I don't think she's going to be able to do this. So my old Golden would do it better. All right, here we go. Ow, ow!
Oh, that was great. That was great. She had to look up.
My dog just jumped up. Sorry, Chester.
I love it. Well, great. Well, Gary, thank you so much for being on. It's really been a pleasure to have you.
Thanks, Bill. I've really enjoyed it.
And I also want to thank all our old dog listeners out there. I know there's a lot of other things you could be doing right now, but the fact you've taken the time to join us means a lot, and we really appreciate it. Please note everything that Gary talked about today will be accessible in our detailed show notes at the Old Dogs website at olddogsreinetwork.com/blog. And you're going to look for the episode with Gary Beasley. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.